What a rally into the close. It is Tuesday, February 18th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York. We're flying solo today, folks. We're doing a bit of a different show here on Overtime. For the next 30 minutes, abbreviated version, I'll take you through a market recap, and I'll take your questions. Consider this a Q&A version of Overtime. Tell me what you're trading, what you're thinking, what you're looking at. We'll try our best to respond here in the chat. Production team, feel free to flag anything noteworthy of important to me. But before we get to the Q&A, let's talk about this market in today's session, which saw stocks surge, well, relatively speaking, into the close. We can share those charts here, Paul. We find ourselves looking at an S&P 500 that is up by 0.25% now, 6147, a 15-point bump there in the final few minutes of trading. The Nasdaq likewise finishes in positive territory, up by 0.2%. Your Dow Jones up by a paltry 0.04, and the Russell is overall the leadership group today, up by 0.61% here. We don't really need to go with the back and forth because it's just me, and we'll just go right into the sector performance here on this Tuesday session of Overtime. Sectors here overall, most of them are up. We track 20 here on futures, on Overtime. 5 of those 25 were in the red. 20 of the 25 were in the green. Top performer today, oil services up by 1.69%, XME up by 1.48%, SMH up by 1.44%. On the other end, the biggest loser, home construction, down by 1.19%, as our U.S. Treasury yields rise across the board. We see here that home builders also up by 1.14%. And then not that big of a loss for the third place loser, XLY, down by 0.28% here today. There was a question already. Did we close at a new all-time high? S&P 500, not quite, but in the SPX cash index, we do. SPX cash closing here today in at 6129.58. This is a new all-time closing high for the index. The previous all-time high close comes here on January 23rd. That was 6118.71. So the beat marches on. Before we turn our attention to what's going on in other markets here, there were a few things on the equity side of things that, we'll say, drew my attention here today. In particular, the February Bank of America Global Fund Manager Survey came out. This survey, which includes 205 panelists who manage a rather large $482 billion in assets, finding 89% of those individuals see that stocks may be overvalued here. I had another chart to pull up, and there we go. That's what I wanted to look at. So let's go to what Sam Rowe shared today of the TKR. Definitely recommend following Sam on X, Twitter, Blue Sky, wherever you may be. First off, this is what we see here. Fund managers, lots and lots and lots of bullish sentiment right now in the market. B of A strategist Michael Hartnett points out that an average of 81% of fund managers have considered U.S. equities overvalued throughout the 2020s so far. So the survey shows that 73% of investors see U.S. stocks as the most crowded trade, down from 80% in January. But this is perhaps the more interesting chart that's getting people talking. It's the fact that we're seeing that most investors and most fund managers are putting their money to work right now. Currently, we are seeing cash flows at 3.5%, a 15-year low. Investors basically are saying we need to get out of things that burn a hole in our pocket. The market's moving. We need higher yields. We need to be compensated for what we're putting to work. And so the money's out in the market. But it could be a sign of overall too much bullishness right now. There's a lot of crowded trades out there. This would be the time of the year, at least seasonally speaking, that one would get concerned about it. Great chart shared from Ryan Detrick, both visually and in the tabular form, if you want to look at the whole year on a seasonal basis, day by day since 1950. This particular stretch here that we're in right now, the second half of February, it's not usually a good one. The gains that we typically put up in the first half of the month, those are ones that are knocked backwards. Ultimately, is it a problem for us traders here who are operating on the long side? Boston Frank is saying SPYs and QQQs are at all-time highs today. That does appear to be the case when we look at this market in today's session. SPY, that's a nice thing for investors to see. They go home from work, they open up their 401ks, their SPY investments. Never been bigger. That's not a problem and certainly generates a little bit of a wealth effect in people's minds. So you have SPYs closing in at 611.45 here. We have the triple Qs. Those are in at 539.37. Previous all-time high close was on December 16th at 538.17. I'll get the words right sometime here. Stocks, they are continuing to move up. From my trading perspective, not sure what other people are doing here going into this week. I'm taking a look at my 6150, 6300 call spread that's still on. There's still a good time to expiry, 17 days, but we're rolling down the other side of the decay curve. So it's at the point where it does need to be rolled. That is a top priority tomorrow. We don't want to expose ourselves to a significant downdraft and then ultimately find ourselves good idea, bad time. And so right now with the market trading in at 6148, I'm going to hold on to my skis here for another session. But these markets look like they're in breakout territory. And for a lack of an audience here that will, rather lack of a counterpart here that will push back on my bullish sayings, I'm going to stipulate that maybe a market closing at all-time highs isn't bearish, is probably a good thing. And so when we look at these futures, ESH5, that continues to push up. The NASDAQ futures, likewise, they rebound after weakness earlier in the day. They're putting in their third highest close ever here in the futures market for this contract, only eclipsed by what we saw in the days preceding that that December Fed meeting here. I'm seeing a lot of people, or at least some, saying that they were trading zero DTEs today. God bless you. Honestly, that is just not the market for me. I'm a little wordy. I'm a little convoluted sometimes in my political and macro thoughts. So I can't say that I'm that great of a scalper. I eschew it myself because I have to stick with what works for me. So those people trading zero DTEs today, good on you, good for you. I really wish I could master that skill set. I see here someone saying that they are short gold or simply don't believe the move. They think it's short covering. What do you think? Vito, I think that's a great question here. It's actually one of my better performing positions. It's something I find myself on the opposite side of you, however. Last week or 2 weeks ago, rather, with Jamal, we rolled up the call spreads that we've been riding in gold from the start of the year, second week, when it looked like the symmetrical triangle was breaking out. Currently long the 2950, short 3000 with 36 days to go to expiration. And this is a new all-time high close for gold in the futures market. I mean, sure, we didn't set a new absolute all-time high today, but it's still a market that's moving up. And as a momentum guy who simply just tries to follow the trend, this is something that continues to trend to the upside. And then philosophically, if you're doing it short GLD just at face value, or if you're doing it through something like the options, I stay away from trying to fade gold, silver, really any asset that has a positive relationship with volatility by trying to sell calls. If the price moves up like it does today and you happen to see a spike in volatility, you can get whacked on both ends. I call it the double tap that I like to avoid. So I would rather look for a break in the momentum or the characteristics of the market that have defined the uptrend before I would even step in front of a move like this. And so to that end, what has been the defining characteristic of this market since we started breaking out? There's no moving average that's sacrosanct, right? I happen to like the 5, 8, 13, 21 EMAs because that's just going up the Fibonacci scale. Now, 5 is rooted in the logic of 1 week. 21 is rooted in the logic of it being the average trading month, 20.7 days. In between, though, if we take a look at the 13, as we break out here in January, this gap between the 5 and the 13 EMAs, it's been holding up. We haven't seen a breach of that zone thus far as this move and lurch towards 3,000 has continued. So I'm operating on the long side. The characteristics look like a bullish breakout. I'm not one to call a top. And granted, in a momentum trading style, if you're long, you're going to miss the top. The final trade in the chain will ultimately be a loser. And likewise, if you're shorting a market on the way down, it's going to turn against you at some point. And that last trade will be a loser. So, in this particular setup right now, I prefer to stay operating on the long side in gold, long side in silver here, which likewise is pushing back up with a $33, 37.5 close in the futures market today, now up to 33.43 after that official futures close. Both gold and silver up over 1.7% today, so shaking off that Friday weakness. Likewise here, I'm sticking with my guns and hold on to the SIK5, that call spread that was established back at the start of February. I'm curious if anyone else here is trading gold or silver on the long side, how you guys are approaching it. There's a great cherry picks that just went out today. Dr. Data and Nick just put out a little section on GDX and GDXJ, the realized vol that you're seeing in the miners versus the junior gold miners. Highly encourage you to go check it out. I don't really trade the gold miners myself. I know people like Vic do. I know Nick, Dr. Data are looking at it right now. So if that interests you, those certainly have been at the top of the heap, soaring here in recent weeks, recent sessions, as we've seen gold, silver, what have you, absolutely crush it in 2025. To that end, XME, we talk about the general speaking materials, metals and mining ETF, that's bouncing up. But you notice it's not at all-time highs like gold is. So if you want to play gold and silver, probably just better to play the gold and silver. Good question here from Darren. I'm seeing a few on the NASDAQ right now, or before we get to that, Chris. Steve, Sam Rowe on Twitter. Let me just pull that chart back up for you so you can take a look at it. This fine guy here at Sam Rowe. Great newsletter, great read. And then the other one was Mike Zaccardi. He publishes all sorts of charts. Fantastic follow on X. Definitely check them out. And then Ryan Detrick was the third one. Likewise, another great follow. Lots of interesting information if people are approaching the market from a technical quant perspective. We're using price action and data around price action to help inform what you're doing. These three reproduce a lot of what you're seeing in financial media, Bloomberg, hedge fund analysis, right? They're either accumulating it themselves proprietarily or they're publishing what other people are doing. So information trove. Couldn't recommend them more. Quite frankly, I think I may be able to get rid of everyone else in my follow feed if I only had to whittle it down to those three people. Most of my market analysis would be in front of me anyhow. But let's circle back here. Talking about the Mag 7 names, there was an interesting move in Meta in today's session. It's the first day down in 20, but we do see that stocks push higher here. I would make the argument that Meta is weakening today because people are taking profits and they're rotating elsewhere. While Meta's down by 2.76%, the Mag 7, broadly speaking, is off by 0.72. If we want to think about the NASDAQ in equal weighted terms, that was up nearly 1% today, higher by 0.98% and closes at a new all-time high. So breadth in this market is improving right now. So you have a QQEW at a new all-time closing high, a triple Q at a new all-time closing high. And I really think the story there is that the DeepSeek Monday has basically been vanished from our memory. I would posit, and I would highly recommend for people that don't take me at my word, go revisit the shows that we did from January 27th, 28th, 29th, talking about the DeepSeek news and what it may ultimately mean for markets. I was making the argument that we were shifting from phase one, the picks and shovels, into phase two, the gold rush, the applications phase, if you will. We've laid the infrastructure with the GPUs. We're now moving the bottleneck from the company that controls the infrastructure build out to the companies that control the applications, the consumer-facing, business-facing applications. Today, we actually marked an important milestone. NVIDIA closed the gap that we had from the Friday before DeepSeek Monday. And as we've seen this occur, that little basket of stocks that we've been tracking, as it were, compared to the broader market, we call it our phase two basket here. And I'm pulling that up right now to put on the screen. Bear with me. Am I going to pull it up on the screen? And it disappeared. Well, that basket today is hampered because of what happens in Meta. But overall, names like Amazon, names like FDS, FactSet, we've seen some upward movement here. SPGI has done quite well, S&P Global. Meta, of course, is part of that grouping that we were discussing earlier. Oracle, Palantir, among a myriad of names. The point here is that ultimately we were questioning whether or not DeepSeek meant that we had laid too much infrastructure, that all the capabilities that we needed to get to this next stage of the AI revolution were behind us. CapEx spending would crater. It was over. An important development occurred last night. Like him, don't like him, Elon Musk, Grok AI, XAI company, put out the new Grok 3 model. Now, the Grok 3 model hit some very impressive milestones. In fact, if you compare it to ChatGPT's 4.0, if you compare it to Gemini, if you compare it to DeepSeek or Claude 3.5 Sonnet, it is scoring higher on all the aptitude tests: math, science, language, learning. And it goes to show that this Colossus supercluster that Musk built with its 200,000 GPUs, it does actually produce the scale of improvement that one would expect if we're continuing to see these linear type of results. The too long didn't read version of that is compute matters. Compute matters if you're going to build better models still. You can do it the DeepSeek way. You can do it in a cave with a box of scraps like Tony Stark did. But you can also do it in a way that produces better results if you have the firepower. And if you have the firepower to do it, it took Elon Musk's company 18 months to get here from when it came off the ground. So clearly the infrastructure build out is working, and it can continue to work. So we're moving from phase 1 to phase 2, but we still may need more infrastructure. Semiconductors are at that top of the heap today alongside the miners. We see SMH is getting back to where it was basically pre-DeepSeek Monday. We closed that Friday in at 261.53. We're now at 256.22 after hours, basically 260 on the dot. All right, just reading through some of the questions here. Maybe it's a masterclass in AI copium. Seems to be working. We'll have to continue to push on as long as the theme goes, right? And this has been a point I try to make as traders who are operating in these shorter term cycles. These bubbles could build, these themes can run, the markets can stay irrational for longer than the typical 45 and 21 day out. And so if you're a longer term investor who's thinking about capital allocation and your longer term required IRR, you can look to a price to earnings ratio and say, you know what, I'm just not getting the value here that I want. This is not my risk profile. But for us to, look at one of these themes in the face and say, this is it, it's over, without the corresponding price action and call the top, that's difficult. And so while I'm a momentum trader, when it comes to the price action itself, is also a momentum trader thematically. As long as the pillars of the theme remain in place, then ultimately it should still bear fruit, even if you have to work through a period where there's digestion in the headline indexes. But that digestion may be ending, as we see with the triple Qs and QQEW continuing to push to those all-time closing highs in today's session. I would posit that Meta is probably the most interesting one to buy in a pullback if there is a little bit more opportunity. Broadly speaking, any of these proprietary data providers are going to be the big ones, in my opinion, that succeed moving forward in this phase 2 name initially, because you need the data. You can't train models on slop. And a lot of what's been flooding the internet out there in recent years has been slop. That's why people are amending their Google searches with like pre-2023 or, Reddit first. Google isn't what it once was. I don't really use Google for search anymore. I bounce between the AIs. Theta says, blink twice if you need help. Listen, if you want to come on the show with me, feel free to come on. And Ilya's out this next week for vacation. He's traveling the country. Dylan was a little bit out sick today. Paul, we can do that. We can have guest hosts coming off of YouTube. That'll work, right? Is that allowed? I did see something earlier in the chat about oil prices here, why they're moving up today. I suppose it's worth giving a brief discussion about what's happening in the Russia-Ukraine negotiations. Well, I should say the U.S.-Russia negotiations. Ukraine has been sidelined, and Zelensky canceled a trip to Riyadh, Saudi Arabia, to partake in the discussions. Part of the conditions for the ceasefire is for Ukraine to hold elections. I don't know. It feels like Zelensky is not going to agree to that, but let's forget that for a quick moment here. Consistent with the idea that we've discussed in recent weeks and months that if there is a ceasefire and the sanctions are lifted, like it, don't like it, that's just the world we may be living in. Ultimately, then a lot of Russian oil that's been moved around the world in shadow fleets probably can come back to the market at market prices. So that probably means a little bit of elevation. OPEC Plus today puts out an announcement that they're probably going to be slowing their roll in terms of boosting production moving forward. That's not a great sign. There was also a Ukrainian attack today on a Russian oil pipeline that affects the flow of Kazakh crude to the Black Sea. So oil gets a little bit of a bounce, up 1.6%. I don't have any oil trades on right now. I don't have anything on in a trading account for XLE. I have some accumulated XLE and XOP from over the years that I don't really touch. But in terms of directional trades right now, I have nothing doing in the energy space, well, oil in particular. Most of my exposure is still through that theme of AI and through natural gas, which today has a resplendent session up 6.95%, breaking out to a new yearly high here. We've been operating in the NGJ5 contracts, 36 days to expiration right now, sitting on that short put spread, and that's working out very neatly as a result. We're basically getting into the teeth of where max profit is starting to arise, so taking this off and resetting it is probably going to be my path moving forward. But as we've learned with this AI build out, right, and I think one of the reasons why we see this move in natural gas today and the associated energy names in the complex today is that we have this realization that we need the data centers and we need the energy to power them. There are companies that have done well in recent sessions that are playing into this trend. We've been talking about EXC as one of my favorite setups, Exelon Energy, as it goes through this potential bottoming process. They serve the Pennsylvania area, and Pennsylvania is going to be the location of some major data centers moving forward, Eastern Seaboard type of stuff. Also, it's a data or an energy provider that doesn't really run the risk of wildfires. That is one of the problems that I've run into looking for names where data centers may be, particularly in California. Do you really want to have one of those names in your pocket, given what we've seen recently? So I like the natural gas trade. I much prefer to be trading natural gas right now. It's directional. It's breaking out. It has more volatility embedded into it. It plays neatly into a theme. I prefer to keep my long delta going there rather than look at anything in oil right now. Although contingency plan, let's say oil, all of a sudden we wake up tomorrow and we're at the same price, but it's an 85 IVR. Realistically, let's say it's a 40 IVR. I'm putting an short iron condor trade on here immediately. Midpoint of the 52-week range, juice then becomes worth the squeeze. But at 14.9, I just don't really see it for myself here as we look into this week. Andrew, this is a good question. How do I struggle with bonds so much? Great question. Yeah, that is definitely my macro mind overriding the common sense of the technically driven momentum market here. You know, it's beginning to look like what was maybe an inverse head and shoulders pattern. Now we're consolidating more into perhaps a triangle over here, which is frightening unto itself because in the context of the previous decline, it would mean being long is the absolute wrong call, wrong side of the trade. Top left to bottom right, this would be a symmetrical trying continuation effort. My shtick, though, is that we've seen some extreme pricing in Fed cut odds, and the world that produced the move in bonds, both in ZB and ZN here at the start of the year, was largely driven by fears that we'd be looking at, a spark runaway in inflation coupled with 25% tariffs. And as we decompose the recent inflation reports, the bump in transportation services more or less has to do with a rebasing of energy prices and motor vehicle insurance and people pulling forward purchases of used cars and car parts in anticipation of tariffs. So are those one-off type of purchases and events, a rebasing of oil prices, right? Last week's CPI report kind of rolls over us. I would posit that, yeah, if we're trading this purely technically, we're waiting for the next leg lower. I think you're absolutely right. But unless we get back to a world where we're only looking at one cut potentially through the end of next year and 25% tariffs across the board, we are looking at some headwinds starting to build for the U.S. economy, right? The economy is on strong footing coming into 2025, but the fact is that the data trackers that I look at and that I consistently look at for as long as people have seen me here on Tasty, the Atlanta Fed GDP Now growth tracker and the New York Fed Nowcast are beginning to show signs of topping out. The New York Fed Nowcast is not as dramatic as the Atlanta Fed GDP Now growth tracker estimate decline. That was at 3.9%. It's now down at 2.3. And so if we're seeing decelerating growth, that does mean that the balance of risk may be towards the Fed cutting if ultimately the labor market weakness begins to set in and the economy slows. We're not there. But this is not an environment where the Fed would even consider hiking yet. So getting, my mind off of that convexity of the long end of the curve, long bond position has been a difficult siren for me to ignore. But I keep getting punished for it. So the beatings will continue until morale improves, evidently. And I'm definitely trading in fear of my own shadow of what happened with the yen last year, when I was waiting for long yen for the first half of the year, then threw in the towel, and immediately the first trade that decided to not go in long yen again was the trade when it exploded to the upside. And that is a situation that I can't ignore happening here in bonds. All right. Just looking at some other questions here. I really appreciate all the commentary here. I'm trying to get to a lot of it. I'm seeing a lot of the same type of comments coming into this today. So if I mentioned someone's name, but you asked about, SPY or triple Qs or ES, just know I tried to get to it. So I do apologize for not calling you out individually. Defense contractors, as we close out the show, are those overblown? Look, there has been some weakness here. We talk about names like LMT, Boeing, Raytheon. They've certainly taken it on the chin, particularly since Donald Trump became the front runner in the race back in October. If you're looking at LMT or Raytheon or Boeing, any of these companies that manufacture arms as a potential guide for geopolitical risks, if you're looking at volatility in oil as a potential guide for geopolitical risks, you have to feel pretty good about things right now. On the other hand, if the U.S. is going to stop being the provider of the Western world's security umbrella, and if the Western world wants those bona fides, then they need to increase purchases of U.S. arms, there is a window with which the U.S. becomes the arsenal of democracy again. And if it serves as the arsenal of democracy, what weapons suppliers are going to be out there to help Germany and France and the UK boost their, military spending as a percent of GDP to palatable levels? Probably American arms manufacturers. So these are on my radar. Volatility is very high, LMT 95.9. Let's see a break of this 1 week moving average first, something that we haven't been able to close above since January 27th. And then maybe we can go fishing. But you know what, folks, that's it for today. Overtime is out of time. This was a special edition, only 30 minutes, abbreviated version here as both Spivak and Radigan were out. No one wants to hear me drone on for an hour, so I figured I'd save everyone that bit of pain. Hopefully it was a good trading session for you all. I really appreciate your feedback and your comments. Please do come back tomorrow, though. Overtime, we'll be back same time, same place here on Tasty Live, as we are every Monday through Thursday, right after last call, 4 p.m. Eastern, 3 Central. So I've been Chris Vecchio. Good luck trading. After this, video on demand, and then macro money at the top of the hour, another video on demand with Ilya Spivak. But stick around. It's good content. See you soon.
Tomas, we are back, my friend. You know what that means? Time for a little bit more Tasty Live with Market Measure, sponsored by the CBOE. Everything's unchanged, Sadnoff. You mean the S&P's up $1, NASDAQ down 15, Russell up $1 and change, the Dow down 100, volatility unchanged, bonds down 18, flirting with 115, Sadnoff.
You know what's down 15? Meta.
Meta is down 15.
Like to say good call.
And Netflix down $12 and change too, but you are correct. Meta down 15. It's a good one out of you.
I just covered some short calls we sold on Friday. Yeah, it's a good trade. We'll take it for once.
You're allowed.
I'm allowed. Why not us?
Why not you?
I just bought back some of the 800 calls.
The 800 calls, 335.
Load a day.
Close to it for sure.
I'm Tom Sosnoff. He's Tony Batista. It's 9:07. We are based in the beautiful freezing Midwest. You want to know what it is today?
-6 this morning, Sadnoff, when I got in my car. -6.
Well,
I'm here because I'm a trooper, Sadnoff. That's right.
I'll tell you what it is
Company
right now in Chicago.
I was going to tell you one. I was going to say 2.
1 degrees.
Mm-hmm.
Partly cloudy, 1 degree, but it's sunny.
Surprised you don't have short sleeves on and cutoffs, jean cutoffs.
Did your son wear shorts to school today?
No. No, I actually sent him a text message and said, it's -6 degrees. Coat? Question mark. Because he doesn't wear a coat.
Yeah.
They just wear hoodies.
Yeah. Yeah. I'm surprised he didn't wear shorts.
He says he does have nice legs, so he is short worthy.
Well, he's a Batista. Of course he has nice legs. Of course. What Batista ever said they didn't have nice legs? Yeah. One, but don't worry. By the time you head home this afternoon,
It'll be 3?
it's going to be 11.
11. Beautiful.
Yeah. It'll be good.
Beautiful.
Be careful on that ice, Tom.
You know, my other shoes have spikes.
Yeah.
I needed those this weekend, but no, today I'm not. I don't know if I'm going outside.
You're not going outside? You don't plan on it?
No, I don't really have an outside. I have to make one stop this afternoon. So yeah,
You are going outside.
I know. I just realized I have to go outside. It's a little scary.
What jacket did you wear today?
What?
What jacket did you wear today?
I didn't wear a jacket because I didn't have to go outside.
You have a jacket.
I just brought a little, like a soft little Levi's jacket. I mean, I don't really have a winter jacket. I don't have a winter jacket. I didn't bring gloves either. I don't know.
You rebel, you.
Yeah. Anyway, it's like I said, it's just a little after 9 o'clock in the morning. We're in the Central Time Zone. This is we broadcast out of Chicago. Tasty is located in the West Loop of Chicago. If you're wondering where you're watching this from, we have been doing this now we're going into
15th year almost. Right?
Beth, is this 15 or 14?
This is 14.
14.
I mean, yeah, since our official birthday, 2011.
Since our official birthday, 14 years nonstop. We're longer right now than Seinfeld. You understand that, don't you?
I do not. I did not understand. I know you mentioned that before. I forgot about that.
Basically, any other sitcom. How long was Friends? What's the longest running sitcom?
Why don't we ask?
Why don't you ask ChatGPT? See, make it good for something. What is the longest running sitcom?
Do you want to guess?
I don't have chat.
I don't know. I was going to say Friends, Big Bang Theory.
The Simpsons.
Oh, The Simpsons. Yes. How many years?
34 years.
Oh no, they killed us. All right. What about something with humans?
Something with humans.
Like how long was like Big Bang Theory on? That was on a long time.
Oh my God, you are so funny with Big Bang Theory.
Well, which one would it be? Friends? Was that on longer? What about with people?
Yeah, not cartoons.
You
Not
talk
cartoons.
faster than I can type. 1 second, please.
Come on, you got to have ChatGPT up and running. You got to be, you got to be on top of this. This is the whole AI game.
Okay. It says Roseanne, over 10 seasons.
Okay.
Will and Grace, over 11.
Wow.
Murphy, I mean, it's a long
I never would have guessed those two. What's the longest running one?
Checking. Talk amongst yourself.
And don't
Amongst yourselves.
don't tell me like the Merv Griffin show. I'm just talking about like a sitcom.
Yeah, like a real one.
Yeah.
Curb Your Enthusiasm, 12 seasons.
Wow. Curb Your Enthusiasm was 12 seasons?
It's Always Sunny, 16 seasons.
Wow. Okay, good. Well, we're right in the middle of that. We got 14.
Beautiful.
Big Bang Theory, here's your show. 12
How long was
seasons.
MASH on for? Wasn't MASH on forever?
I don't know. Big Bang is 12 seasons?
My Taiwanese sources say Roseanne doesn't count because she came back. She canceled, she ended, and she came back.
Oh,
Not uninterrupted.
I never watched Roseanne. I never watched Will and Grace either.
Neither
So-
did I.
Can't say I watched those two shows. But, all right, I was just curious.
Seinfeld, 9 seasons.
It felt so much longer. I can't believe Curb Your Enthusiasm was on longer than Seinfeld. Look at all these little stats that
Grey's
Friends.
Anatomy, 21 seasons.
Grey's Anatomy? Huh. I never watched that show.
Gunsmoke, 20 seasons.
Gunsmoke was great. Never watched it.
Lassie, 19 seasons. I don't think I ever watched Lassie.
Love Lassie. And what was the dolphin? Flipper. Love Flipper.
I don't see Flipper up here. Sorry, I don't see Flipper up here.
Flipper saved a lot of people.
Bonanza 14. I remember watching that with my dad.
Sure.
Sure.
Like those old shows, right? The Rifleman, Chuck Connors.
Rifleman. Yep.
Yeah, like those shows.
Thank you, my Taiwanese sources in production.
Yes, thank you so much. Anyway, Tasty, 14 years and going strong. Broadcasting.
Just like yesterday.
What?
It feels like yesterday.
Yeah. We've had 3 locations. We're in our 3rd one now. We're all together with the whole gang. So hell, the gang's all here. There's about 300 people total at Tasty Trade and Tasty Live, if you're curious about the size of the firm. That's just in the U.S.
Beautiful.
So, all right. We got a lot of stuff to do today, so we'll keep moving. But I should say we haven't announced our travel schedule yet for 2025. We've been keeping it under wraps because we have had a couple of local events here in Chicago, but we will announce our travel schedule in March. It's going to be really interesting this year. We're doing some crazy stuff, but we do have one small event coming up in Chicago, the 3rd of a 3-part series. We did Ryan Grace and crypto, Dr. Jim and beginning trading. And then we're doing Mike, his whiteboard, and his friends. Mike, his friends, and his whiteboard in Chicago on Sunday, March 9th. It's a Sunday night. It is full right now, but you can sign up for a wait list if something opens up. Who knows? Mm-hmm. If you're not in Chicago, please don't sign up because unless you want to fly out here, but it's only a 90-minute show. You're more than welcome to, but right now there's no space available. But you can watch the show, what Mike does, because we are then filming it and recording it, and we will be playing it on Saturday morning, March 29th at 10 a.m. And then we will repeat it. So we'll play it twice. Saturday morning, March 29th. And if you sign up in advance, you own it. You can play it as many times as you want. It's a digital collectible. It's minted. It sits on our blockchain, and you can have it forever. So stream it on March 29th and own it forever. And Mike is, over 10 million of Mike and his whiteboard have been viewed on YouTube alone. It's insane. So does a really good job. And Katie and Nikki are going to be on stage with Mike. So also doing.
So he considers his friends.
Doesn't have a lot of friends that we have to give. We bought him 2 friends, and so it's got no choice. But I think you'll like it. I think you'll like it a lot. It's a really good piece, and I'll be there too. Looking forward to it.
Beautiful.
All right, let's do this. Measuring the odds of this is our market measure sponsored by SIBO. Measuring the odds of large daily moves in high volatility stocks. Measuring the odds of large daily moves in high volatility stocks. Let's go to the
sponsored by the CBOE.
Let's go to the first slide. In this segment, we delve into the dynamics of major market shifts in an effort to uncover patterns in their occurrence. Specifically, we aim to answer 2 critical questions. All right, Pat, here are your questions.
Ready.
How likely are significant market moves to happen within a defined time frame? And how can we quantify the major ETFs and liquid single stocks? By analyzing past events of similar magnitude, we can assess the probability of such shifts taking place again. Think they happen often? Not too often? Major market moves, obviously more so in stocks than ETFs. Obviously.
Individual stocks, sure.
Individual stocks.
Yeah, it's harder to move 500 stocks or outside than it is for one stock, sure.
How likely are they going to happen? Because you know why we're answering this question? You know why we're
Because we don't want it to happen. We play the don't line.
Exactly. The reason we ask this question is because this is not good for business. So let's go next slide. So we used 2 ETFs, the SPY and the Qs, and we used 2 stocks, Tesla and NVIDIA. The reason we chose Tesla and NVIDIA is because those are the 2 most liquid of optionable stocks. Those are the 2 most liquid. Of the ETFs, SPY and the Qs are the 2 most liquid of optionable ETFs. We did 2015 to present, 10 years. We calculated the probabilities of having a certain number of 1%, 3%, 5%, 7%, and 10% daily moves in a 5-day trading window. Okay, you got that?
Yep.
1, 3, 5, 7, and 10 in 5 days.
Okay.
Next slide, please.
I can't guess. I mean,
No. On the four most active option trading vehicles. Okay, so the first one, we start with SPY. The likelihood of experiencing from 4 to 5 days a 7 or 10% movement within a single week has been 0 for the last 10 years in the SPY. However, the probability of encountering at least one movement of 1% or more in a week is relatively high. Additionally, the SPY has an average daily movement of 1.11%.
So I mean, if you're gonna have, it's gonna happen almost every day. If you're gonna say that, right?
Well, let's take a look. We have the numbers right in front of you, right there.
Mm-hmm. And
a 1% move, and this is just happening. You can see the numbers happening once, 25%, twice, 18%, 3 times, just across the board.
So what are you worried about? It's really what it's saying here. What are you worried about?
Exactly. I mean, but don't jump right to the punchline. Have a little fun with this. So the chances of having a 10% move, I mean, you can see or a 7% move, we're in the 0 handle, and 1, 3, 5. We put all the numbers in front of you. The chances of big moves are relatively small, but when they happen, they're very, very painful.
Yep.
Relatively small, very, very painful. Let's go next slide. Similar to the SPY, the Qs have also shown a 0% likelihood of experiencing a 5, 7, or 10% move in a single week. Looking at the past 10 years, the Qs have an average daily movement of 1.37 compared to 1.11 for SPY. And you can see the numbers across the board here. They look very similar. Would be difficult to differentiate between the Qs and the SPYs. But the numbers look kind of pretty basic, pretty much across the board the same. My takeaway from this would be the same thing. If, understand nobody looks for a 10% move.
Of course.
I mean,
nobody plays for it.
In the S&Ps, a 10% move in the S&Ps would be 6,000 points. Mm-hmm. That's a lot.
It's a lot.
Yeah.
Yeah.
So you're not going to see that. A 1% move, 60 points.
We'd be closed.
Oh, we'd be closed. We'd be shut down.
Mark circuit breakers.
Yep. Let's go next slide. Over a longer time frame, like 10 years, ETFs tend to remain stable, with the daily moves typically staying between 1 and 2%. In contrast, individual stocks like Tesla and Nvidia exhibit higher volatility, making significant price swings more frequent. So now we'll take a look. Let's go next slide, Beth. So as a highly liquid and volatile individual stock, Tesla, we expect to get more daily movement, with the average daily move around 4%. So the SPY 1.1, the Qs 1.37, and Tesla 4%. That's why it's so actively traded, because people love trading something that moves around.
And that's why they all have higher implied volatility, too, monthly implied volatility, than you're going to see in an individual stock, than you're going to see in an ETF.
The probability of experiencing 5, 7%, and 10% movements within a single week still been 0 so far, but at least one movement of 1% or more per week is relatively high. Yeah, of course. And when you start to look at the numbers here, they're very different when you start talking about stocks that move 4% a day. But the prices also reflect that. So when you look at the amount of money that you make or have the potential to make, that's why Tony said this morning his best performing stock this year is Tesla. Yeah, because you can make more money in there. Or Nvidia or whatever else it is. let's go to take a look at the next slide, which should be very similar in NVIDIA. NVIDIA has also shown a 0% likelihood of experiencing a 5, 7%, or 10% movement within a single week. And over the past 10 years, it's experienced an average daily movement of 3.5%, just under what Tesla has. And we played out all the numbers for you here so you can see. It's very interesting.
Yes, it is.
Just, you get paid over three times trading NVIDIA over what you would in the SPYs, because that's how much more risk you're taking. You get paid 4 times in Tesla over the SPYs because that's how much more risk you're taking. Let's go to the next slide. So there's very little probability of having a bunch of large moves back to back. According to our study over the past 10 years, individual stocks have exhibited more than 3 times the frequency of large daily movements compared to ETFs. And since early 2025, we've seen more large market movements compared to 24, offering profit opportunities to increase liquidity, but also posing risks like loss, distress, margin call slippage, and requiring strong risk management. This is all super interesting.
Good stuff. Super interesting. Even the S&Ps are unchanged still, Sadnov. What do you think about this market today?
It's kind of impressive.
We're going to take a quick 90-second break. When we come back, we got more Tasty Live with Joy, your friend of mine, Mr. Scott Sheridan, next. You'll be super impressive because we haven't done anything, and we've been up almost every other day.
It's super impressive that it's been able to hang in there. Yes.
We'll take a quick 90-second break. We'll come back. We got more Tasty Live. Netflix down 19.
Same with Meta.
It's option jive.
Tomas, it's time for a little bit of an option jive. Even the S&Ps haven't moved, up 24.
They have not moved, and I thought we would be. Oh no, I'm not filled. Yeah. Yes.
All quiet.
All quiet.
Mm-hmm.
I'm Tom Sosnoff. He's Tony Batista. This is Tasty Live. It is 8:11 in the morning. It's Tuesday morning. Long 3-day weekend. Can't handle those 3-day weekends. Are we done with 3-day weekends finally?
It's got to be, right? I mean, this is
Beth,
it.
are we finally done with 3-day weekends?
I think until Memorial Day.
Oh, good.
Bearer of bad news, Beth.
Or no, yes, Good Friday. Sorry, I'm a cashew.
Good Friday. Good Friday is the market closed Good Friday?
Yes.
Oh, it is?
I didn't.
Yes.
Oh, okay. I was not aware. Thought we were. I guess we're closed. Yeah.
It'll be okay.
All right. Let's see what we got here.
Yeah. Mm-hmm.
Expecting moves. What is Good Friday? What's the date?
Ay. Hold on.
No, I'm just thinking something. Hope I'm not off on my dates.
What were you thinking?
What day is Good Friday?
It's April 18th, Tom.
Oh, April 18th. Expiration Friday.
Boomer Spring Break Friday?
No, Expiration Friday.
Yeah.
So what do they do? Expiration on Thursday?
Yeah.
Wow, that's a weird one.
It's probably happened every year for the last
Never. I've never
7
remembered.
years. Every 7 years it's probably happened. It has to.
I don't ever.
No, it's on a Friday. It's going to happen every year.
It's Good Friday, but it doesn't happen that day. It's never Expiration Friday in April. What do you?
I bet it has. I bet. I got a lot of Venmo money.
Hold it. Are you betting me that it happens every year?
No, I'm betting that it's happened before. You said it's never happened before on expiration. I'm saying it has. I have no knowledge.
Well, that's for sure. I would say that
that was professional there too, right, Beth?
I would say that.
Oh, yeah.
Mm-hmm.
I mean, if it's happened.
Okay, now you're going to say it happened.
Maybe once every 7 years. I don't know, but I doubt it. I doubt it. I don't think we've had a Good Friday on Expiration Day in forever. I don't know what Good Friday. I don't know what the whole what the significance of Good Friday is.
Okay.
I'm gonna try to find.
There go your emails.
What is Good Friday? Is that like,
Oh, I'm not telling you.
Yeah.
I know we celebrate something. Mm-hmm. It's Easter weekend, right?
Correct. Yes.
Yeah. Mm-hmm. Ham. I get ham.
I mean, it's one of the holiest days of the year, but whatever. I'm not gonna tell you.
It is. I make beans and ham. Delicious.
Good Friday comes each month. Good Friday comes each month.
You're too slow.
Can't find.
I've been trading a long time. I don't ever remember Good Friday on
I
Expiration
bet
Friday.
Vecchio can find it.
Oh, Vecchio, he'll use.
Oh, Vecchio, no. Vecchio, can you get on that for us? Because we're going to have Vecchio coming on and let me explain at 8:40. Can you explain Good Friday to us?
A little chat GPT.
And tell us how many days Good Friday fell on an expiration. How many times, please? So I can win $100 off of Sosnoff.
I didn't bet you, but nice.
Oh, okay. Now you're backing. Whatever.
All right, anyway.
Option jive. Let's go.
Expecting moves up versus down. Let's take a look and see where the boys went with this today. Option jive. Using implied volatility to compute expected move helps retail option traders figure out strike placement without having to be experts in a particular underlying. This goes back to what that last emailer sent to us on Confirm and Send. How do you pick your strike? If returns were normally distributed, moves would be outside of this 32% of the time and inside of it 68% of the time. Various factors show that the market does not really expect a normal distribution. Focusing on skew, let's compare how realized up moves and down moves differed as multiples of expected move. So we're going to show, Mr. Batista, is that if you are, for example, if you want to sell calls, you may be more consistent with the strike that you select. Mm-hmm. And if you want to sell puts, you may vary it a little bit.
The calls you would sell the furthest out of the money that you could find, right? Because you don't.
Well, the call skew is going to be maybe more honest than the put skew. Let's put it that way. Because the put skew has to factor in velocity, and the call skew doesn't do the same. Let's go next slide. So we use 10 years worth of a price and IV data in SPY, IWMQs, Apple, Amazon, and Google. So we didn't just use the ETFs. We examined the realized 30-day price changes as a multiple of the 30-day expected move using the implied volatility for most underlyings, but we using the implied VIX style implied volatility for most underlyings and the VIX itself for SPY. Looking at SPY or all the underlyings taken together, we contrasted the distribution of up days to the distribution of down days. Yeah, I think that that's going to be a big difference. You're going to see that on down days, there's a lot more variation than on up days.
Makes sense.
Right? Because on up days, volatility contracts, and on down days, volatility expands. Okay. So the distribution on down days is going to look a little more funky than the distribution on up days. That's my guess. Let's go next slide. So the first slide we see here, this is the SPY, and you can see, you can see the how well, we're kind of just showing essentially how just what it looks like in just in a bar graph.
Distribution curve.
Yeah, just the distribution curve in the SPY, up moves and down moves. So mean values, median values, and what's the last one say?
68th percentile.
68th percentile.
Yeah.
Yeah. Just showing you that we're generally, we live inside of whatever the expectation is. This is basically saying that given the theoretical projections, the actual, what's actually realized is inside of that. Mm-hmm. Let's go next slide. So we look on this again. This time we're looking at all symbols, and we're looking at the numbers in a very
buying notes.
Ooh, we filled on those. We're looking at very similar numbers with a theoretical of the theoretical expectation of, let's call it, 68%. We're looking at kind of, where we actually live. And what it shows is that the numbers are significantly better on, for premium sellers, the realized numbers are way better than the theoretical numbers.
Which is what you want to see.
That's what you want to see.
You look to sell premium.
Yep. Let's go to it's just a, it's kind of a very broad overview. And you can see that, one of the things that this slide shows is that the up moves are pretty measurable, right? And the down moves, I should have explained this better. The up moves in green are pretty measurable. The down moves in red are much more erratic. If you go back one slide, Beth, just go back one slide. Yeah, you can see here the same thing. This is SPY rather than all the other underlyings. But it's harder to tell in SPY. Yeah, it's tougher to tell in SPY. But if you go to the next slide, you can see it it's much clearer how erratic the down moves are and how clean projected the up moves are. You go to the next slide. So both the up moves and down moves, the normal distribution is based on expected moves over estimated realized moves. So here are the takeaways. For up moves, this was due to a large clustering of moderate sized moves between 0.5 and 1.0 of the expected move. The down moves, on the other hand, were more erratic, having a very large number of quite small moves along with a heavy tail, but a small but not trivial number of very large moves. And that's exactly what we saw. A much more erratic graph with a much longer tail and much greater peaks. So while checking on the expected move is a good first step for placing strikes, don't be afraid to adjust the put side and the call side separately to take exactly the risks that you choose. So can I tell you how we get around this?
Sure.
We get around this by sometimes adjusting to price. So like you can, is that bonds?
Oh, that is bonds, 47 on the 113 puts that you sold.
Yeah, so what I did was I bought some notes just under 119 to give my average 119, and I sold some puts in the bonds at 45 and 47 to give my average 46. Just so you know. I'm done for now. What we do is we will sell an option a lot of times, just what the team wrote here, rather than picking a specific strike that's equidistant away, or rather than picking a specific strike that is the same exact delta, we will adjust by sometimes price, which will then adjust for us, it'll adjust the skew for us. So, and sometimes like we'll say, I'll sell a $2 put and a $2 call, even though the $2 call might have a 25 delta and the $2 put might have a 22 delta.
Your Good Friday thing, I got the answer. I really would have won $100 multiple times.
Really?
Yeah, since you've been trading Sosnoff, I won't count 2025, but 2022, 2019, 2014, 03, 2000, 92, 87, and 84. 87 crash. Good Friday fell on an option Friday. Now it's doing it now, so you better be careful.
It's happened 7 times in 43 years.
1, 2, 3, 4, 5, 6, 7, 8, 9 times since 84.
9 times
since 81.
Okay, 10 times since 81. So in 44 years, it's happened 10 times. You think that's a statistically significant?
No, I think it's what's going to happen all the time. I mean, I think it's just it looks like it's every 3 years or so. I mean, there's a leap year in there, so.
Yeah, sorry. I don't think you win that one. All right.
Thank you. You know what? I'm going to out you, Shark. Thank you, Shark, for being Team Bat. Appreciate it. We're going to take a quick 90-second break and come back. We got more Tasty Live after this with the opening bell next.
markets get a little bit of a reprieve following yesterday's shenanigans with the CPI report that spooked one and all. But did we really get to a place where we can really and truly say that the markets can finally stop worrying about the Federal Reserve? That is, of course, the key question for us as we consider where this might be going. And that's what we're going to unpack here as we look at the event risk that comes at us from here. And we'll do a little bit of unpacking of how it was that we got our little reprieve today. And of course, yesterday we talked about the U.S. retail sales report that still comes at us with that release on Friday. So tomorrow, less than 24 hours now. But in the meantime, as we get ready, it should be helpful to see exactly what the markets did here and why. And then look beyond that retail sales report to next week, where the event risk only gets hotter. So, yesterday, the CPI numbers gave us a very discontented bond market. We can see that right here. The bond market sharply lower yesterday, and then, of course, today we can see that move has been wholly erased. We've essentially returned to where we were before that move occurred. Talked yesterday on the show about how that might have been the last large downtick in the bonds for a while, and indeed today not only was the move arrested, it was fully erased. So what happened there? We'll take a look, but before we do, here's the story from stocks. Yesterday we can see the markets initially sold off on the hot CPI number, only then to finish the day little changed. So not really taking the cue from the bond market there. And today, rallying. Part of that, of course, the data we'll discuss here, in part the announcement that reciprocal tariffs from the Trump administration may not arrive, if at all, until April, maybe. That, of course, diffuses a risk that they might appear much sooner than that. So we get a little bit of a rally, but ultimately stay within this narrow range that we've carved out since late November, early December of last year, sort of depending on how you frame this sort of congestive period here. But what certainly seems to be clear is that there's not a whole lot of conviction still, because we, of course, not only remain underneath that high, but we've only just closed the gap from that DeepSeek fiasco and nothing more. We struggled to even make a run at the secondary high here from early in the year. So a little bit of upside from the markets, but conviction still seemingly lacking. For the U.S. dollar yesterday, it initially strengthened on the data. Today, a reprieve there as well, selling off against the euro here. We're looking at 6E futures for the euro as a kind of stand-in for the dollar's overall direction, because, of course, the euro is its largest counterpart, and the general benchmark, the U.S. dollar index, is overwhelmingly tilted toward euro, because most of the legacy currencies that make up the basket are now the euro, like the Deutschmark or the French franc or the Italian lira. And so when we look at what's occurred here, yesterday the dollar tries to rally. It manages it against the yen, for what it's worth, even though it gave it away today just as the bonds gave up their losses and erased that. But in aggregate and overall, the dollar ultimately doesn't get much headway thanks to CPI, much like stocks don't get much of a downdraft. And today, as stocks extend, so too the dollar pulls back lower. So what is this sequencing and what's going on? So here is the CPI report that we ended up seeing that ultimately spooked everyone. 3.3% on headline inflation versus 3.1 expected. And indeed, this core number rising, whereas it was expected to come down from 3.2 to 3.1 and ended up not only not going down, but actually going the other way and unexpectedly accelerating. Unexpected acceleration at the number, including food and energy as well, the broader number here, 3% versus 2.9. And not surprisingly, that shook the market's expectation for how much the Fed might be able to cut rates. And so that's this sell-off in the bonds. Why were stocks and currencies more circumspect? Well, as we discussed yesterday and we'll briefly review today, it seemed like what was going on in the inflation numbers was actually not all that scary when you consider where the headline numbers came from. They mostly came from the goods side of the ledger rebasing, so the negative contribution from goods to CPI became smaller, and energy swinging from a marginally negative reading to a marginally positive one. But when we look at where most inflation actually lives, the core services sector, it went down. In fact, we can see here in the breakdown, this is the inflation that matters. This big, thick gray area, that's where the Fed's progress to 2% inflation will be made or broken. And what we see is that on this measure, we actually come in significantly. 2.62 percentage points is actually the smallest contribution from core services to overall CPI in years. And so what the markets took away from this was actually that the numbers probably don't change the Fed's calculus terribly, because the part of the equation where they have agency actually seems to be moving in their direction after these temporary and, for the most part, statistical adjustments work their way through the data. Now, more worryingly, what this rhymes with is a sobering set of PMI numbers that came out last week, suggesting that the U.S. service sector has started to significantly cool. And of course, that's the essence of why we get this sort of skew in CPI. Notice almost nothing for inflation for goods for quite some time. Food has been squeezed down. Energy is still very low, if now no longer negative. All of this is happening in core services. And then when we look at what's going on with the drivers of growth for the U.S. economy, we can see it's services with the strength, whereas the manufacturing side has been anemic and only just returned to growth last month. As ever, these PMI numbers are done around an axis of 50, where that's neutral. Above it is growth. Below it is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what you find here is a significant downstep in this critical sector. And not only do you find it in the S&P global data, and albeit here it's more dramatic, but a parallel PMI data set, this one from the Institute of Supply Management, ISM, it also misses on its service sector gauge. 52.8 versus 54.3 expected. Not quite as dramatic. This gives us a 12-month low on U.S. economic growth, thanks to a steep come down in the service sector. This gives us a more modest come down, but still the weakest reading in some months. So as we look at this, in the context of these CPI numbers, the markets say, well, maybe the story here is, at least from the immediate Fed policy perspective, not a prescription to jettison rate cuts altogether, as the bond markets seem to be worrying about, because clearly the underlying economy, that is the service sector, its sole sort of pillar of growth and support, that's actually cooling. And what the CPI data marks is another step in that direction, following on from the PMIs, both S&P Global and ISM, that were leading us there already. We get a further reprieve today from the PPI report, and this helps to cement the sense amongst the markets, seemingly, that yesterday's CPI numbers were not what appeared at the headline, at least at first blush. So consider here the overall PPI number, the headline number. It comes in hotter than expected at 3.5% versus 3.2%. But after the revision to the previous month's numbers and revisions higher, it actually ends up unchanged. So it is higher than it was thought to be, but it isn't a step in the wrong direction from what was there in December to what was there in January. The core reading, again, excluding energy and excluding food, which is much more relevant for Fed policy officials since they can't exactly mandate global food and energy prices, that view is even better. So again, 3.6, higher than 3.3 expected, to be sure, but also a step lower after you consider that the prior month was revised to 3.7. So at least in terms of the direction of travel, wholesale inflation is telling us a story that is much more relatively benign than what the headline numbers for CPI suggested, and what ultimately CPI started to look like once we unpicked what was under the hood. Where does that leave us on Fed policy expectations after all of these gyrations? Well, now we are sitting at what appears to be about the wall for where hawkish rethinking of policy expectations could ostensibly go without the Fed fundamentally altering its posture. And this is why, when we look at next week's minutes from January's FOMC meeting, this becomes that much more of a live risk for the markets. So consider, in the wake of all this back and forth, where do we end up? We have one rate cut that's baked in for this year. 31 basis points is a bit in excess of one cut that's being baked in. So one cut at 25 basis points there, and an extra 6 basis points toward a second one. So a very small chance that we get two cuts this year. For next year, we're basically 50-50 on another cut at 11 basis points. The likelihood of one is just a touch lower than 50%. So on net, we're looking at 42 basis points now in overall easing through the end of next year. Now, why is this significant? Well, you'll notice this is about where we were when the markets were at sort of peak consternation in December. And that was, again, around this idea that the Fed may need to ease less than the markets want. That's this right here, this pullback. And the last time that we were here on rates, we were about here. So we are at this point aiming for less than half of what the Fed itself projected. Right here is the expectation for this year as of the December update of the summary of economic projections. The next update comes in March when the Fed has its next meeting. There's quite a lot of time now before the Fed actually makes the next adjustment, giving the markets lots of room to speculate. What we have then is from 4.4 to 3.9, that's 50 basis points this year. And from 3.9 to 3.4, that's another 50 basis points next year. In aggregate, the Fed thought that through the end of 2026, they would do 100 basis points in cuts. The markets now are, as we see here, at less than half that. And so when we consider then what could be happening, if in fact what this data is telling us, the CPIs, the PMIs, the PPIs today, if what it's telling us is the markets have moved to this hawkish setting because they're afraid the Fed doesn't have enough room to cut and are now close to 60 basis points more hawkish than the Fed itself, if we are to take this move at face value, then the next adjustment is for the Fed to do no cuts this year. With only a single cut that's priced in, the only place you go that's more hawkish than this is no cuts at all. And for next year, we're already there for the most part. So when we consider what this means, the question becomes, is this fine-tuning, going from 25 basis points to 50 in cuts, or to 75, or back to 50, or back to 25? That's managing the pace. That's managing the timing of when easing comes. But going from we intend to cut to we no longer need to cut at all, that's a tactical and strategic change in the overall direction of Fed monetary policy. And that requires all kinds of additional further forecasting, especially when the markets are this far offsides from the Fed itself. Now, this is where these minutes become so consequential. The Fed told us in January an outlook that was very measured. All it did was basically tell us that on the whole, we are just going to sit and wait. Consider, inflation remains somewhat elevated. The unemployment rate has stabilized at a low level, and labor market conditions remain solid. And those were really the only edits. The Fed here clearly is non-committal and wants to wait and see. That's what we heard in the press conference from Chair Powell after this meeting. It's also what we heard from him in testimony in front of Congress, now both Senate and the House, this week. This does not sound like a Fed that's changing its mind about the overall direction of travel, and instead is more so trying to fine-tune when it's going to make the next move to ease. That would suggest that this right here has reached about as hawkish as it can go, give or take. If the minutes then come out from this January meeting and tell us the Fed remains committed to the direction, they are not rethinking the path to where they want to end up, they do want to be cutting, what they're trying to figure out is when to do the cutting and how much of it to do. And if their cutting cycle is entirely off the table, well, that doesn't seem to be in the cards, unless, of course, Fed officials start to talk about it. If the minutes do suggest that, then, well, we could have another big run-up in yields. But if not, this appears like it's reached something of an exhaustion point, or at least very close to it. At the same time, the other big update on economic data next week will be conveniently enough, the next set of S&P Global PMIs. Unless we lose sight of what truly matters here, this cool down that we just talked about for the US, it marks convergence with what's been going on in the Eurozone and China, the other two major economies. So we talk a lot here on Macro Money. The Eurozone, China, and the US make up 58% of global GDP. And the other 42% are, for the most part, vendor economies that need demand from the large three in order for them to have a sizable or at least a meaningful contribution. Those incoming PMI numbers for February, they're going to tell us more on this story where the Eurozone and China have been slowing since basically the end of the first quarter, beginning of the second quarter last year. And it's been the U.S. holding up the entire global economy, maybe until January, where we're converging toward slower growth. And if that's the case, then the signs of weakness we've now seen in CPI, the confirmation of that underlying softness in PPI today, all of that seems to suggest that not only is the economy on weaker footing and there is a global recession risk that might be brewing if this continues, because if the U.S. slows, there is no safety net from the other major economies, but most importantly, that this is now incorrectly hawkish. And what all that boils down to then for asset prices starts to look like bonds that are relatively cheap and have perhaps room to break out and extend higher as the markets start to consider that the Fed is going to need to do a lot more easing downwind, even as they resist now. And for stock markets not to necessarily love that news, because the easing will not be fast coming. Again, the next Fed meeting is in March. They would need to significantly rethink their perspective if they were going to speed things up aggressively. In the meantime, the global economy would show significant signs of wear and tear, and this top may well hold with a turn lower. And of course, if the markets are speculating on Fed easing before the Fed really gives them the support and the confirmation that, in fact, it sees things the same way, the speculative element here might well drive down the U.S. dollar as the markets seek to push the Fed toward a conclusion, or at least anticipate that it will get there, which probably means a weaker U.S. dollar once next week runs its course. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go from there. I'm likewise on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.
Know someone who needs a better broker? For 1 month only, earn $500 for each qualified person you refer to Tasty Trade. See how it pays to have friends? Terms and conditions apply. Tasty Trade.
I bought a stock when I was first old enough to open a brokerage account. It went up 1,000% and I made a bunch of money and I was hooked. I felt like I was just pretty much gambling in the markets. I had a big win and it was mostly failures thereafter that. And I thought I need to find a way to consistently pull money out of the markets and find a more consistent, repeatable system. Fast forward, I ran into tastylive. Really loved the market measures and the data they had behind to back up the research they were doing. My biggest takeaway is that you can find an edge in financial markets. It lies in volatility overstatement, volatility mean reversion, and having solid mechanics.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
It was a great show, very inspirational and motivating.
I feel like you got to know each of the traders a lot better on a personal level. It was awesome.
This is my 10th or 11th live event. I thought the math would be really complicated and it wasn't, and then it just made sense.
They've opened my eyes to many different strategies.
And I realized there's a reasoning and strategic planning that you could do to be successful. I love all you guys.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
If you say way to go out on a ledge, what are you doing?
Way to go out on a ledge is just another expression when you make fun of another trader who's not willing to take any risk, who's very risk averse. So when somebody's very risk averse and doesn't want to do anything risky, you say, "Hey, way to go out on the ledge."
When you say you're going to whack the bid, what are you doing?
When you whack the bid, that means you're selling at the best available price.
A scoopy.
Scoopy Scoopy! That's one of my favorite. That's when you're just like scooping something at the bottom, like, you know, you bought something and it never goes lower. Scoopy.
Back in the pits, you guys call them teenies. What are teenies?
A teeny is a 16th. So before we went to decimalization, we used fractions. And we used 16ths under a certain dollar amount.
Do you want the penny or the position?
Well, that's always something. The penny or the position is, do you want the trade? Then just pay up to get the trade. But do you want to squeeze it for a penny? That means you're just going to wait until you get filled.
When you say Omaha, what happened?
When I hear Omaha, I know I've gone too far.
So Tom, what is your definition of underwater?
The futures close 15 minutes after the cash markets close. So underwater means when the futures close under fair value, under the cash price.
If you're selling in the hole, what are you doing?
Oh man, if you're selling in the hole, you're puking. That means you're selling it at a price you don't like, but you have to do it because it's hurting too bad.
Tom, in the pit, when somebody would say it was an out trade, what would that mean?
An out trade's a mistake. That means one person thought they were doing one thing and the other person thought they were doing something else. And so an out trade is just another word for mistake. You can use an out trade in anything in life. When you just have a misunderstanding, that's an out trade.
When Tom says double whammy, what does he mean by that?
Ooh, double whammies when you roll down calls because the stock's going lower, and then all of a sudden the stock goes higher and you start rolling up puts, you're getting double whammy.
What is going on? Welcome back to today's segment. We've got some things to talk about. Pretty aggressive sell-off today, then a little bit of a rally into the close, but we'll touch on those things here in a minute. What's going on today, guys? How are we doing? What's new? I know we were having a lot going on this week. I believe Trump was supposed to be talking here and there, and then I seen more talk about that on the socials. But other than that, we don't have any earnings that are standing out to me too much, but we'll go ahead and talk about everything. But again, before we get into all of that, how are we doing today, guys?
I'm doing well. I'm having hardware difficulties here. This thing started popping out of my ear the second we started.
No,
going.
I know the hearing aids. The hearing aids, man, they're annoying.
Production just
I gotta
got me.
adjust
We're
mine too.
handled.
At
We have the
times.
greatest production team in the world. They've figured it out. I've shucked the earpiece for today. But yeah, no, I'm doing really well. No new positions through the long weekend. I mean, it's obviously the first day back since the long weekend. I didn't find myself trading anything today. No super attractive spots.
Did you wake up Monday morning though? Did you wake up Monday morning opening or expecting to open up the market?
Well, no, I don't know. It's trading is it's become a little bit linked to coming to the office now. So when I woke up Monday and was like, oh yeah, no, I'm not going in. It kept me from opening up the platform. I do still have this DraftKings position that we talked about last time. They had one of the worst earnings calls I've seen in some time, and then it rocketed, as we discussed last stream. That's the way of the world.
Of course.
So there was a time when I was down like $200 on it. It's began to come back down a little bit. I'm down 100 now. Expiration is Friday. I don't think that I want to manage. It was supposed to just be an earnings play. I'm not going to extend this into some broader bearish sentiment that really doesn't exist at all with me as far as DraftKings and these gambling stocks are concerned. So. I'm looking to close that one. Might be able to dip out, but my strike is 47.5, so it's kind of gotta die or I will die. Those are the two options. But outside of that, looking good across the board. What's up?
Yeah, no, I was gonna try and make it seem like the glass is half full. But 47.5, we are a little bit of ways away, but maybe the market will digest a little bit more and come back. So other than that, is DraftKings the only one you were pretty much eyeing this week?
Yeah, I mean that's my only one that I have to decide how I want to manage it. I'm also eyeing Amazon a little bit. It's come down. I mean, everybody we talked to, you had that Amazon trade. Everybody and their mom was bullish on Amazon around this office there for a little while. It's come down to 226 now. So I'm feeling like this is maybe a good range for a buy spot, especially at a discount, considering when it would be a discount to me, considering when it was alerted by everybody initially. So got my eyes on Amazon from a TA perspective. Haven't pulled the trigger quite yet, but it does look prime for a bounce. I'm actually just sitting here, and now that this day candle has closed, this is a nice butterfly doji here on the bottom. So. Think we could get a move out of Amazon. That'll be my main watch list tomorrow.
Looking at Amazon right now too. No, we're down a little bit. IV rank is decent. Volume is pretty decent. I'm looking at the 29 delta right now. That's giving me about $1.20, but with the $5 wide, I don't think that's something I want to take. I mean, the pop is 70%. That looks pretty decent. But until then, I'll keep an eye on it. That's in the 58 days till expiration, so I'm probably not going to get much more out of it if we if we go any closer. 133. That's not as bad, but then again, that's a 34 delta. I'll be patient on it. Not enough juice for me. But if we do continue to sell off a little bit, especially this week, it'll make it more attractive because we're getting more of a directional move to the downside, and then hopefully I'll be able to collect a little bit more credit. Do you kind of like the vertical spreads as well? Is that more of your go-to with DraftKings, Amazon? What is your kind of style
if I
like?
don't want to be naked. is the answer.
Okay.
I have no problem with going naked here and there, and on DraftKings I am naked. Just sold one call. So if I'm playing in earnings, or if I'm doing something where I know I'm spinning the slot machine in the first place, I'll just try to. I usually won't go covered. I'll just try to size my position accordingly, and take a position that I would be prepared to lose 100% of. And so that's what my mindset was with DraftKings. But yeah, I like the verticals. If you want something that's a little more, defined risk. And sorry, I'm distracting myself looking at Apple here. I'm
you're fine.
I'm intrigued by what this event tomorrow is going to bring, and I'm looking at the market sentiment here. I don't know. I mean, honestly, this is a bearish point in this chart if it existed in a vacuum in a purely TA sort of context. Clearly running out of bullish momentum. Sitting here looking at the Ichimoku cloud, it just crossed a red, which is a major bearish indicator. Channeling down. This is interesting. But obviously, Apple is not a purely technical stock. And that event tomorrow is going to be interesting. They're rolling out a new iPhone SE. You seen that?
I didn't. What is the SE? What is the SE all about? Is it a similar? You know how they took the side quest when they made the colorful iPhones? What was it, like the iPhone Cs or whatever they were called? Is that going to be the same route they're taking there? And enlighten me there.
Yeah, that was the 5C. They only did the colored ones one time, I think. Now the SE is it's smaller. It's the same functionality, but it's smaller. It's like iPhone 4 sized. I mean, they're small, like 4 rows of apps. And I mean, I think that there's a place for it. I've actually been saying for years that I can't believe they haven't caught on more. And I guess Apple is going to heed that advice and take one more whack at it, because phones.
I'm sorry, you said it was going to be a smaller iPhone. Is that what you had said?
Yes, it'll be the same functionality as an iPhone 16, but it's just smaller. Is the only thing.
We've really came full circle.
Yeah, I know. We wanted to go bigger and bigger and bigger, and suddenly we need to go small again. And I'm here for it. Like I said, I have I just recently got a 16 Pro, and that sucker is big. It's a big phone. It's big.
Well, what did you have before that? I feel like a lot of the iPhones kind of been the same size over the last 5-10 years now.
Well, no, I've actually been very surprised because I have my personal phone is a 14. I got the 16 for content stuff, but the 14 is like considerably smaller. I mean, I don't know. I mean, we're talking on the margins here. It's like an extra centimeter of both length and height. But when you set them on top of each other, it's notable.
Was it the Pro or the regular one, or the Max, or whatever?
The 16 Pro Max is the new one.
Okay.
Yeah, which I think is a little bigger, but they do just keep growing. And yeah, I mean, this thing, I can feel my phone in my pocket right now talking about it. So I think there's room in the market for a smaller phone, and I'm surprised they haven't made a more aggressive push for it sooner. I think it'll do well. I'm bullish on the idea, but we'll see how the market actually chooses to react, because we might be a little overextended up trying to price in this event.
Yeah, I mean, we might be a little bit. I know we're getting a rally into the event. I mean, just looking at the expected move on Apple, I mean, we can get a decent credit. We can get it just under a third of the width. So come Apple event, we'll see how that kind of pans out. Other than that, I haven't really been looking at two. Go ahead.
No, I was just going to say, these Apple events, it happens every time where the market, like in this case, I'll use the SE as an example, the market will say, oh my God, they're going to announce the SE. They're going to announce the SE. And it runs up and it runs up, and the event happens, and the market's like, what the hell? They only announced the SE. And then it goes back down. I've seen that Apple pattern happen a lot surrounding these events before. So I'm expecting there to be exactly what was promised, and then the market to be underwhelmed for some strange reason. That's sort of my prediction.
You think it's kind of like a sell the news kind of vibe?
I do. I think that anybody, Joe Public that just started trading yesterday is aware that there's an Apple event, and that's probably going to do good things for the share price. And that's, it's like what we talk about pre-earnings. Sometimes a good earnings will get overly priced in to the extent that even once the good earnings is reported, it just goes back down.
Yeah. I hear you. To do a little tour to market real quick. I know we kind of rallied into the close, a little bit of a sell-off coming into the morning. I mean, exactly at 9:30 Eastern, we had a little bit of a sell-off, sold off throughout the next couple hours, kind of consolidated through midday, and then we had a rally into about the last 5 minutes of market open. But we'll circle back around to that. Volatility increasing a little bit today, especially into the open, and then as we get into the close again, a little bit of a decrease in volatility as the market started to rip to the upside. Give me a second here. We'll get this, and I guess we'll go on to SPY, and then SPY trading at near all-time highs right now as well, and then QQQ following suit. I believe QQQ is not all the way at its all-time highs, but I mean it's getting there. But no, volatility is really nothing to write home at / oh, am I typing this in? There we go. There we go. Volatility still looking a little bit dead. I mean, if we just zoom out over here, the last time we really got any type of significant expansion on vol was over around December, around the first couple weeks of December, and then since then it's been a little bit underwhelming, I would say, on the overall market. But that's what we have there in terms of the positions that I have on. SPY, I sold a call spread on SPY, 615 calls, collected about $1.96, so my break even is about 617 on SPY. Decent amount of time to go on there. We'll be managing that by next week. And then QQQ, these are two that I had actually put on today. So I sold 2 call spreads. I sold the 540s, bought the 545s. I collected about $1.60 each for both. So I have a total credit of about 322 on that QQQ. And then that one's going to expire on Friday. So I know we got a little bit of a rally into the close, but I'll talk about how I'm going to be looking to manage these positions, especially because these expire so soon. So other than that, we traded a little bit more futures again. Not sure why they're not popping up, but we got a little bit of, we caught some points in there as well. And what I'm going to do is with the trade today, I'm going to use that to finance the QQQ call spread that I put on today. So I mean, we made a few $100 on the QQQ, and then again, gonna hopefully use that to finance these weekly contracts. We'll see what we get, but essentially what I'm looking at here. Let me go into these futures / MNQ. If this will load, let me go over here to.
We got
here, we're
ranges,
on the daily,
baby.
but we can use
ranges on this graph.
Yeah,
Let's go.
we got ranges. We got ranges. Let me take this IVR back off real quick so it's a little bit clean. Yo, you didn't even mention, bro. Look at the white background, the blue candlestick. These are blue, right? Blue and black. Candlesticks.
I was trying not to clown my co-host on air, but it is this is a wacky look we got going here.
You think so? Is it wacky, or are you just not used to it?
Is this you choose to do this?
I did. I wasn't forced against my will. I was playing around with the settings today.
The blue and black is really my only qualm. I don't like the light mode, but I understand that that's a matter of personal preference. But there's not enough contrast on the blue and black for me. I hear you. I was playing video games the other day, and one of my buddies was like, "Man, I just changed my colors back. For 2 years, I had made the enemies orange just to be different, and so it was red and orange." And he was like, "I can never tell what's going on," and that's how I feel looking at this. Looking at this.
No, I mean red and orange would kill my eyesight because again, I'm already slightly colorblind, so I can't have any colors that are very close to each other. I know this blue and the black they're very dark colors, but I can definitely still tell the difference.
I would like to propose that this chart is white and gold. I see white and gold.
You're not going to do that to me. You're not doing that to me today, guys. We're not starting that. But this is what we have for the day. So this top zone that we're looking at over here is going to be where most of the trading activity occurred, specifically 70% over the last, I believe it was the last 4 to 8 weeks. So that's where that one's coming from. And then I took my short this morning, essentially shorting away from this level and then targeting the next level down here. It's not like it's not like, oh, this looks like a support, so I put a zone there or something like that. These levels are derived from using the volume profile. And as we know, the volume profile is a distribution of volume on a bell curve. And I know all of us at Tasty are very familiar with bell curves, the one standard deviation, those kind of things. So these zones are essentially going to be the one standard deviation of the trading activity that took place, depending on which time frame that you're using. So that's what I'm looking for this week. Again, I sold the 340. Was it the 340? Oh no, I sold the 540 call spreads on QQQ. So essentially what I need to do, or essentially what I'm saying by putting those positions on and the opinion that I'm expressing, is my break even is going to be around this level up here for QQQ, maybe a little bit above there, but that is where my contracts are pretty much going to break even at. So as long as we can stay beneath these levels, again, we'll see what happens overnight. But that's the opinion that I'm expressing based off of the positions that I have on today. And then again, took a very directional move, or a very directional trade this morning. I sold, was it 1 or 2 contracts? I think I had 2 contracts. I sold a couple of the micros. And while we were sitting within this range after the market opened, I debated too. I was like, you know what, let me snag. I was going to snag a few of the at the money puts. But the thing that I was waiting for is I wanted the best risk to reward, especially if I'm trading options directionally, especially those 0 DTEs. You have to really be careful on managing your risk. So I was waiting, or I wanted to see price come up here to this value area low. That's what it's really called. But I wanted to see price come up here. So I was waiting for a pop this morning into this level so that I can put on some at the money put options. And it just was not popping at all. I mean, the aggressiveness of the sell orders this morning was just so extreme this morning. So I shorted a couple of the futures contracts, and I'm telling myself, okay, if I get the better risk to reward, I'll then go ahead and pull the trigger on the puts. But we never got it. Obviously, it ended up selling off, but that would have been a decent opportunity. But at the end of the day, you know, if the risk to reward isn't in my favor as much as I would like it to be, I'm just gonna have to size down and just use smaller size within that trade. Because again, even though that trade would have worked out, I would have been pretty upset if it did end up stopping me out, because that's a wider risk than I would have wanted to take on. So I just kind of think ahead to myself sometimes. Like even if I could have ended up making money on this, if it were to not go my direction, would I have, 1, been following my rules? Would I have, 2, been following my risk parameters, most importantly? And then number 3, is this a trade that I would take again? So it's kind of bittersweet seeing it play out sometimes, but at the same time, it's like, I'm going to just lean on the side of risk management when it comes to those things, especially, again, using some of those zero DTE options and at the money. But anyways, that's pretty much all going on my side. After that, the market was kind of trash, I feel like, the rest of the day into the afternoon. I mean, the price action was pretty choppy throughout the rest of the day after that initial move down. But again, 5 minutes before the close, we got a pretty aggressive rally. Still have those call spreads on, so we'll see how that pans out throughout the rest of the week. I'm not going to hold those till expiration on Friday. I'm going to take these off at around 50 to 80% if I'm able to buy these back at about 50 to 80% of the profit. And then I'm going to manage the risk on this one whenever my contracts go up about 50% in value. So I'm not going to risk I'm not going to look to take the entire 322 of credit that I received on order entry, but I'm going to be managing this before expiration. Because again, one of the other weeks, which it was a really good trade, I ended up leaving it. I left it in the account. And then I ended up being assigned on those QQQ shares. Again, I look at my buying power in my account. I'm like, yo, where did all my buying power go? And that let me know, I probably got assigned. So I'm not going to hold them until expiration. I'll look to get out before then. But that's all that's going over on my end, brother. I might be looking a little bit more at Amazon heading into the rest of the week. I know I'll be looking at Apple a little bit more tomorrow too. But a lot of indices, as you can see here, whether that's the NASDAQ futures or the ETF, QQQ or SPY.
Yeah, I think that was an apt synopsis. We had what looked like it was going to be an interesting market today, and it kind of just things just smoothed out, man. I want some vol, man. I want some VIX. Give me some VIX. It's my favorite thing.
Yeah, no, it's been a little dead. Let me go up to vol real quick.
But yeah, I was having a look at earnings that went off after close here, and there's nothing super interesting to even cover. Occidental Petroleum, like, what am I going to do? Sit here and talk about oil? What do I look like, a politician?
Petroleum, oil. No. I don't know, with that stash a little bit. I don't know though.
You think? Maybe in the 80s. I need some some of those like big, not like Harry Potter glasses, but you know how guys in the 80s wore like the big double bar glasses? Need some of those.
Yes. I have some of those, but they're like in sunglass form. But I know exactly what you're talking about. I kind of mess with that style. They're kind of dope.
Yeah. I have one in sunglass form too. Are they called aviators? Is that the deal?
I don't have, they're not the aviators. I know what you're talking about, but they are not the aviators.
I have aviators, sunglasses. Yeah, these Ray-Ban aviators. These are my go-tos. Haven't needed them in a little while. But
I gotcha.
They are in the bag.
Those are the prescription?
What? No, they're not prescription.
Those are the I gotcha.
Yeah, no. But yeah, I think
taking a look at oil right here. Oil's not one that I've directly been trading. It's just so different from something like NASDAQ. Like, again, I naturally gravitate towards NASDAQ because, whenever you're trading a specific product, you kind of start to get a feel for its personality. They almost have their own personality in regards to price action and just the way they move and the typical market behavior. But oil is just one of those ones that I've always stayed away from. I'm gonna look at NAS, what is it, /NG? A little bit of natural gas. Absolutely ripping to the upside. I don't know what's going on in here. Let me check it out real quick.
Yeah, oil is just, oil to me, like the way it exists in my brain, I react to it the same way I do to like Forex or crypto. Like it is like its own entire.
What is that?
Oil is what I'm talking about. Like oil as a whole.
Okay.
It's just, I feel like it's its own entire, I was going to say entire sector. Obviously it's its own entire sector, but it's like its own type of trading. Oil and the way that these things move, it's super duper news contingent. Whereas, a SPY or a QQQ, more traditional indice ETFs are going to be about as financial as it gets. Oil is about as news as it gets, I feel like, as far as like large established products of this size go.
Yeah.
And that's scary to me because, and the reason that I like technical analysis really as a whole is because I don't want to have to be plugged in. I want to have my one screen with my chart on it, and I don't want to have to necessarily be doing too much worrying about when news is going to drop or how earnings numbers look.
You know what's funny? I think some would argue I think someone would I could just hear Grumpy Mike or Lone, one of them just talking about how that's the reason why they don't like looking at, some of the technicals, but which I'm excited that we're going to a little bit more into here.
Yeah, no, I agree. I mean, everybody has their own style, and as you absolutely should, and everybody's profitable doing their own thing. But yeah, it's why I like TA. I just I want my one chart with my lines on it while I play games on my phone. That's what I want. That's my Gen Z trading. I want to be able to scroll TikTok and glance up occasionally and see if I need to exit. That's
maximum dopamine.
Yeah, exactly.
Maximum dopamine.
I'm dopamine maxing. I'm screen maxing.
No, 100%. I hear you. I know, again, like you kind of just mentioned, oil is very affected by news, especially any type of news that's, referencing the supply or demand, barrels, whatever the case is. Definitely very sensitive to any of those topics of the news.
When oil got below $0 the one time, I think we may have touched on it on the stream before or something, but like, I'm going to be honest, still don't really understand how that even happens. Like, what do you mean it's under $1? It's under $0 a barrel? I mean, because it's obviously, I mean, I don't know. Does that mean that there was a period where people were straight up paying you to take the oil off their hands? I guess it does, but like, who's doing it? Oil obviously has value. How is it? I don't know. And I don't need to know. There's too many other sectors and good stocks to trade for me to give a shit. I'm not worried about oil.
No, I hear you. Again, if I was trading oil at that time, or if I was a big player in oil, I'm telling you, oil going negative, I would have been one of the market participants that would have been caught off guard with that. Because if you're seeing oil coming down near zero, you're thinking, wow, what great risk to reward this is.
Yeah.
And, some maybe probably oversized or over leveraged into a position with something like that. Because, I mean, I wouldn't have expected that. But it feels like that was just yesterday. But that was a few years now.
Well, yeah, or like, what if as you're getting towards the bottom there, you're like, oh, okay, I'll sell some calls. This is like fairly defined risk. They can go to zero, and they can go further than zero. Apparently, did calls also go negative? I have no idea. I have no idea how any of that works. I've never.
No, yeah. I mean, I wasn't trading.
Who needs to know? Who would have ever taught me what happens to your calls if the stock price goes below zero? Nobody knows.
You don't need to know until you gotta know.
For real.
Until you gotta know. I'm taking a look at steel here. Let me zoom out a little bit more. Very choppy. So it looks like it's not very liquid asset right now. I know there's a lot of talks within, deals and agreements and acquisitions when it comes down to U.S. steel here. But another one that can be really volatile. And sometimes it has these days that just completely sell off. And I mean, I was caught in both of them. I don't know if you remember, but on one of the streams, not too long ago, I believe I was trading steel at around this level here. I sold a strangle here. lagging. If I sold a strangle here, and sorry, a little bit of technical difficulties. Let me try and move this.
It's all good. This is real live
anyways, these
programming
two this is two extreme sell-offs over here in steel. Again, I was really fond of steel because it's a lower priced underlying, so it's something that I could take advantage of selling an undefined risk option strategy on it. And both of the times, both of my put sides was tested because some type of deal didn't go through and I was caught in it live as it was going down, so I had to close both of those positions out. But this was another one that I was really fond on selling some premium on, and because of those last two incidents, I'm not gonna let it push me away from checking this out, because again, I mean, it's one of those, from a visual standpoint, that really likes to trade within a range. So I want to see if I can capitalize on more strangles and iron condors in this product, especially because the premium is decent. It's not too bad. But that's what we have for US steel here. Let me see at the expected move 188. I mean, you're collecting a decent credit for a 70% pop. You can go a little further out to around that one standard deviation, collect $1.50, 74% pop. Is this something you would put on? You like it or no?
I don't know, man. I don't play with commodities too much. I certainly don't hate it. I agree with your point. I mean, the premiums are very attractive. There's pretty large variance from one spread to the next as far as how big these spreads are, but holistically pretty good there too. I mean, I think you'd be able to get a fill at a pretty good price. So yeah, I would say I'm inclined to agree with you. I mean, I think the if you asked me in a vacuum, I would have said, yeah, I think that has about a 75% chance. So I'm right on line with the probability of profit we got going there.
No, I hear you. All-time highs by the end of week, Gus. What do you think? Before we wrap here.
Yeah, I'll say yes. I'll throw my vote into the yes hat there.
I mean, it's looking yes, but I'm hoping not. Again, I sold those QQQ call spreads, so I'm gonna have to manage if so. But I mean, we're really inching towards there, and it wouldn't be too much a surprise if we did take it over here on NASDAQ.
I agree. Is SPY at all-time highs right now?
It's SPY right now. I don't believe. Let me see. I believe we're inching past it here. My cursor is just moving very slow right now. Bear with me now. If I could see this.
Yeah, it's pretty close. SPY and SPX are definitely.
Yeah, just a little bit.
Close.
Yeah, again, I have that SPY position on too. I sold the 615, so I got a little bit of breathing room on that, but that breathing is shortening as each day goes by.
Yeah.
But we are coming to a close here, Gus. Anything else you want to add before we head out and into tomorrow? I know you're talking about that Apple event tomorrow. We'll see how that pans out. IB Ring's pretty decent on there, so I know I'll be taking a look at Apple. Anything on your end?
Yeah, I think Apple event is going to be my thing. Maybe just like a YOLO short on Apple or something off of open. Like I said, I feel this is like, I mean, you put it well. I think this is generally a sell the news situation when these Apple events roll around. Things try to make it overly priced in is a term that I've been throwing around recently, and I think that's where we could be. Then Amazon also strong on my watch list. Might grab something there at open. I was kind of waiting on confirmation on this candle on the 1 day, and I have it. So I'm looking there too.
Awesome. Well, we'll see what we get tomorrow. We'll manage these positions. We'll circle back around to this later this week and see how we manage. It's a shorter week again, so 4-day week. Got to take that into account. But thanks for taking the time to hang out with us. That's going to wrap it up. Be sure to stay tuned for more segments coming up, and we'll catch you guys next time. Peace.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at Tasty Live.
Looking for a better broker and a bonus? Sweet. We got you. Right now, you can get a bonus of up to $4,000 when you open and fund a Tasty Trade account. Plus, low rates, smart tech with the analysis tools you need, and award-winning support. So, get a broker who's actually got your back. And up to $4,000 at Tasty Trade. Make your move, genius. Tasty Trade.
If you missed the live show, here's our cherry on top weekly recap.
Ah, look what the cat dragged in.
Top of the morning to you all. How are we doing?
Rich McDonald from London, he was so excited to tell me that he was on a game show in LA.
You were on a game show in LA?
Yes. He was walking down the street and some Hollywood producer spotted him and goes, "Oh, we gotta have this guy." And what was the game show again? I forgot.
It was called Eliminate.
Oh, I know Eliminate! Eliminate! You were on Eliminate! Oh my God!
You've seen it?
Have you met me? Yes, I've seen Eliminate.
Did you get eliminated on Eliminate?
Who would not pick the Scotsman? Like who? Why? Oh, that's that woman's trash. I'm so sorry, Rich.
The camera's finished, and she turned round to the guy she eventually picked, and she said, "So where are we going on our date then?" He said, "Oh, I'm very sorry, I've got a girlfriend. I'm going out with one of the Lakers cheerleaders. I just wanted to get on TV."
In a tribute to you today, just so you know, we have one of our viewers sent Tony a bunch of Scottish things. The first thing.
I mean, I wanted just a man in a kilt, but apparently I'm just gonna get some pudding.
I don't even know what spotted dick is, really. It says it's delicious. I mean, this is the first time for me trying this. Vanetta, you?
Yeah, I'm on a dick-free diet.
Have you managed to warm up your spotted dick?
It kind of tastes like, you know, like the banana pudding or the vanilla pudding that you get, but that's like not refrigerated.
It's actually pretty good.
Yeah, it's not bad. And I imagine if you go actually to the UK, I'm sure there's places that can do it more authentically.
Is all the custard in cans?
Yeah, pretty much. It's one of those ones. If we end up in a war, then you just fill your bunker with custards and beans.
Control.
knocked me off my pivot today because they came up and they said that you were having, I actually had to go Google this, that you were having a conversation about traditional spotted dick desserts, whatever.
No, it's not a dessert. It's not a dessert.
It's a muffin.
Are you adding this to your repertoire?
It's a muffin. And we poured the custard on top.
You pour custard on top of a muffin. That's dessert.
Okay, American, you uncultured American. Okay, Dylan, explain to them.
I think that the good Dr. Sheridan accurately describes any item that has custard upon it as being in the dessert category, whether you're a sophisticated Milanese gentleman such as myself.
I can't be friends with Dylan Radigan if I eat SpaghettiOs out of a can because the Italians.
I mean, but you can't, because remember, I'm from Saranac Lake. My relationship as a young man with the canned beans was to go out to the ice fishing shack. Because the canned bean is a very staple food for the ice fishermen.
So you grew up in the ice fishing community?
It's a card-carrying member.
Please tell me what the pleasurable portion of ice fishing is.
I haven't done it since, probably I was 16 years old, but our primary pleasure was smoking pot, because you could get into the ice fishing shack.
There we go. Do you actually care if you catch a fish?
No.
Okay, perfect.
With your buddies, you're like, Sosnoff, grab the drill, and then it's like man work, and you got to drill the hole.
Tony is going to counter that and say it's all about catching the fish, for sure.
No. I don't think he's an ice fisher guy. I don't see him sitting around the hole in the ice fishing just hoping a fish pops in.
There's not enough marijuana in the world or Coors Light to get Tony to go ice fishing.
Get the full scoop by checking out the archives at tastylive.com.
Trade size varies between traders. In a larger sized account, a trader might trade 10 contracts per transaction. In a smaller sized account, a trader might only trade 1 contract per transaction. The term tranche allows us to quantify and size to a common denominator. 1 tranche would represent normal trading quantity. 2 tranches would represent 2 times the normal quantity, signifying a larger trade size. Of course, trade sizing is immensely important. We recommend a tranche being far less than your max exposure.
If you missed the live show, here's our cherry on top weekly recap.
First of all, I'm sitting in the captain's seat. I've never been invited to come sit in the new captain's seat. But what I'm concerned with is the size of these screens. And then he's still doing this.
Snow, let's take a look.
They did not hold that rally at all.
Phil, you got a partial. 973.75.
I'm looking at this like I have to move my head to get through the top, the top symbols. I thought he had like a little computer and he was getting down.
He hasn't learned that he could like swivel his head. He has to see the screen. He has to go like this to me. And then you know what? Money goes to money. You did it. Good job out of you. Yeah.
Yeah.
I just drove with him twice. Now I'm really